Welcome back. Welcome to our video lecture series. In the last class, we have discussed about the accounting concept, and I think around 2 to 3 accounting concepts are remaining to be discussed. They are pending to be discussed now. So we'll be talking about those accounting concepts today in this very class. Then we'll be talking about the accounting policies. We'll also talk something about the objectives of accounting, and then we'll see how the accounting can be used for management controlling purpose, or how the accounting information can help the management in having some sort of control over the economic transactions of an organization. So let's start with the class. The concept that we need to discuss is the concept of materiality. This concept says all the things or all the transactions which have a material impact on the decision makers needs to be shown in the financial statements. I repeat, all the transactions having a material effect on the decision maker should be shown in the financial statements. What do we mean by this? The concept of materiality. Let's take it by an example. Let's see it by way of an example. Say for example, there is a client Mr. A who did not pay the amount payable of 100 rupees to a company whose total turnover is 200 crores. I repeat, there is a client Mr. A who has defaulted in paying rupee 100 in case of a company whose turnover was 200 crores. So this 100 in comparison to 200 is immaterial. So I need not show this transaction separately. But if I change this example by saying Mr. A who was to pay rupees 100 crores in a company having a turnover of 200 crores, then this activity becomes material enough to be disclosed in the financial statement. So what material for an organization may not be material for other. Something which is material for company A need not be material for company B. So the accountant would see whether a particular transaction needs to be shown separately or not, and how to do that, how to find out whether a transaction is material enough to be disclosed or not. We will see the volume of this transaction in comparison to the total turnover or total volume of that business. If it's of no use or if it's of a very lesser amount, then we need not show it separately. Let's take another example. Say for example, if a company buys papers, printing papers, it buys pens, buys pencils, erasers, sharpeners, staplers, then it need not show these transactions separately. They can be clubbed together and shown under a single head called as office expenses or stationery. But if this company buys a car, this cannot be treated as a general expense. Why? Because the amount paid for a car is much more higher as compared to the amount paid for this. Also, this car needs to be disclosed as vehicles, whereas these papers or pens or pencils or erasers, sharpeners, stapler, things like that need not be shown separately or need not be accounted separately. These can be clubbed together and be shown as office expenses or stationery expenses. Right? So the materiality concept says all the transactions which have a material impact on the decision maker. If we show it, the decision may change. if I show this, that the amount payable by Mr. A of 100 crores in this company, this may have an impact on the decision makers. He can change his decision, or his decision may be based on this. Whereas if a company buys a few papers or pens or pencils, then the decision maker need not be worried about these small or petty expenses. These petty expenses can be clubbed together and shown as a single, under a single head, right? So this material concept says that as far as it is practicable and feasible, feasibility means the cost of maintaining those transactions. So as far as it is practicable and feasible, we need to show the material items in such a manner that the decision maker can have an impact, can derive an he make his decision based upon these transactions, right? Now we need to also see that the showing of these transactions should be according to the cost of achieving it. Say for example, an amount, a machinery which has been purchased, machine purchased for rupees say 100, right? I need not show this as an asset and charge depreciation year after year, right? What I can do is I can show this as an outright expense. Why? Because the cost of maintaining this transaction for another 10 years would be much higher than the value of this transaction itself. So we need to see whether the cost of maintenance of the transaction, whether it is in line with the disclosure requirements or not. If it is if the transaction or the item that we have purchased of a lesser value, we need not show that separately, or we need not carry it year after year. So this is all about the materiality concept. Then we have timeliness, or it is also called as the periodicity concept. What is periodicity concept? We have seen in our going concern concept. In our last class, we talked about going concern concept. This concept says the accountant need to keep this in mind, that the business would be continuing year after year after year after year after year. It would be for an infinite period. Let's assume that a company, the accountant of a company assumes that the life of this company is more than for a period of more than 100 years. So can he say that since the company would be continuing for 100 years, do not ask the report card or do not ask the financial statements today? You please ask about these financial statements after 100 years. Let the company get closed. Then only we will be in a position to find out as to what was the profit or loss for this company. Can we accept whatever he says? The answer would be no. Why? Because since the life of the company may be of infinite period, but you need to pay taxes at the end of every year. You need to pay dividends, or you need to share the profits at regular intervals. What is this period of interval? This is a period of 12 months, which starts on 1st of April in case of India and ends on 31st of March next year. In some countries, it starts from 1st of January and ends on 31st of December. So the period, the whole life of the business should be broken into pieces, and each piece should be of a duration of at least 12 months. So what the accountant is supposed to do is, he need to prepare the accounting so that the report for a particular year can be known. Why? Because there are many legal obligations to be fulfilled. The Income Tax Act says you need to pay the taxes for every year. Again, when we pay the dividend, it has to be paid on an annual basis, or the interim dividend. So there are many things which are taken care on an yearly basis. So we need to, the accountant needs to follow the periodicity concept also, which says that the accounting has to be done keeping in mind that the result has to be shown or reflected on an yearly basis. What is that year? The year comprises of 12 months, which starts on 1st of April and ends on 31st of March in case of India. Right? So this is all about the periodicity concept. Then we have dependability, or we can also use the term reliability here. Reliability concept says that the data, whatever data has been given, should be dependable. When is the data dependable? When it is free of errors. When the data is free of errors, when you are objective, when you follow the objectivity concept, which means you go by the facts. So if you follow the concept of dependability, it says that whatever data has been given should be dependable, and when the data is dependable, when the data is free of errors. And when the it would be free of errors when you talk about, when you record only the facts, when you are objective while making the accounting entries. So the accounting entities ensure the standards of internal control to ensure that the data used as the basis of accounting records are controlled to ensure their quality, which means the quality needs to be ensured so that the data is reliable or it is dependable. Then talking about the accounting policies, we have already discussed that the accounting policies, there are different accounting policies followed by different organizations. There are many areas wherein you have more than one option to be followed. So the accounting policies differ from organization to organization, right? The areas, the examples or the areas where you find different types of accounting policies are in case of valuation of inventories. In case of valuation, you have many methods like the last in first out method, you have the first in first out method, you have the weighted method, or highest in first out method. There are many methods of valuing the inventories. So the company, what they do is they are free to choose between any of the valuation methods for their accounting purpose. For the disclosure purpose, they may not be allowed to follow any of these, but for accounting purpose they are. Similarly, valuation of investments are also different. Treatment of depreciation, we have already discussed in our previous class that the depreciation has different methods of depreciating the assets. One is straight line method, written down value method, sum of years digit method, things like this. Similarly, the treatment of goodwill is different in case of different organizations. The way in which the goodwill is written off is different. In the same way, the treatment of contingent liabilities, you have more than one options to more than one way to record the contingent liabilities. Similarly, the foreign exchange transactions, you have more than one way to record these foreign exchange transactions. What we mean to say is the accounting policies are the rules which are applicable to an organization. They are made by an organization to be followed by the members of those organizations only. So since it is that case, you have more than one options. And since there are more than one options, you need to choose amongst them. And once you choose that, what we do is we need to follow it on a consistent basis. Right? Then the role of ICAI. So what is the role of ICAI in these accounting policies? The ICAI keeps on issuing guidance notes from time to time, which gives more clarity to the accountants as to what is to be done in a specific case. There are some areas, gray areas, wherein the accountant may be confused as to how the accounting has to be done. So what the ICAI does is, the Institute of Chartered Accountants of India, they keeps on helping the accounting fraternity by issuing guidance notes and accounting standards from time to time. Objectives of accounting, we have already seen that it is determination of income for the purpose of decision making or calculation of profit or loss. It reports, it provides the report, the profit or loss or the balance sheet. It summarizes all the transactions, and it provides the reports. The accounting provides the reports as to how the transactions have fared during the accounting year, whether the firm was at a gain or at a loss, or this type of report is prepared by the accounting. This is one of the objectives of accounting. Then disclosure. Disclosure means all the relevant information which can be of use to the decision makers are to be disclosed. So these are the objectives of accounting: finding out how much profit, communicating this by way of reports, and see if there are some things, some transactions which may have different type of impact on the decision maker's decision. So these needs to be disclosed in a proper manner. Then let's see what accounting and management control is. It says the accounting information can be of use to the management for controlling its activities. How do we do that? When we record the entry in a proper manner, when we summarize them, and then when we disclose them as per the applicable laws. Then there would be a proper disclosure, there would be a proper control by the management on the accounting system, right? Says controlling means the process of keeping the organization in course, whatever we have planned and whatever the actual things are happening, we need to see whether they are in line with each other or not. If not, then we need to take some corrective measures, take some managerial decisions. This involves measurement through the control system. The controller or the accountant and the managers obtain information which enables them to diagnose the situation. If my planned activities and my actual activities are not in line with each other, then we need to take some managerial decisions. So let us have a look at the example whereby we can find out as to how the accounting information can be of use to the management, right? Say for example, there is a firm selling three products, P1, P2 and P3. The profit of the firm is declining, which means the profit in the first year was 300, which has gone down to 200 in the second year. If you look at the numbers, we would find that the sale has been the same in both the years. The cost of goods sold means whatever goods have been sold, the cost involved in selling them, which means right from buying the raw materials to converting them into finished goods, have gone up by 100 rupees. So the gross margin or the gross profit has been 500 in place of 600 here, right? Again, the depreciation remaining the same, other operating expenses also remaining the same, we find that the profit has gone down because my cost of goods sold have increased. Now if we probe further into this, then we find that the three products during the 3 years have fared like this. The In case of product number 1, the sale was 300, the cost of goods sold was 150, which means you had a margin of 50% here, right? If you look at the same product in the year 2, you find that again the sale was 400, cost of goods sold is 200, your margin is 200, which means it is again 50%. 50% of your sale has been converted to profit. Similarly, if we talk about the product 2, again this is the sale value is 300, the cost involved there is 150 and the margin for that is 50, again 50% in this case. Looking at the product 2 in the year 2, we find that the sale is again 400, cost is 200, so the profit or margin is 200, which is again 50%. In case of product 3, if you look at the sale 400, cost was 100, the profit here was 75%. How do I calculate 75%? This 300 profit is earned on a sale of 400 rupees. So 300 divide by 400 into 100. I get 75% as my profit ratio. If I look at the same thing in the year 2 for product 3, the sale has gone down from 400, it came down to 200, whereas the cost remained the same, which means my profit has gone down from 75% to 50%. So the management would be in a position to know that this loss of 100 rupee or the decrease in profit is because of the product number 3, wherein the sale has gone down but the cost have remained the same, which resulted in the decrease in profit, overall profit, right? So this is the manner how a management would be looking into the various aspects so that they can find out as to which of the transaction, which kind of transactions are having the impact on its final numbers. So it says that the sale of P3 has decreased, which was the cause of your reduction in profit, and the cost of goods sold of P3 has doubled in relation to the sales. This was 25%. Here it is 50%, right? So these are the various ways of finding out the impact of any particular transaction. So this is all about our class today, wherein we have talked about some accounting concepts which were left over in our previous classes. Then we talked about the accounting policies, wherein we have seen that the accounting policies are different for different organizations. You have more than one way of recording the transaction in some cases. We have seen those cases, say for example in case of inventory valuation, in case of goodwill valuation, in case of depreciation. So the company or the company or the accountants have a right to choose between these alternatives, but we need to remember that if a method has been chosen for a period, for an accounting year, the same method needs to be applied for the subsequent years also, which is called as the concept of consistency. Then we talked about the objectives of accounting, and finally we have seen as to how the accounting information can be of use to the management for their controlling purpose, right? So this was this was all about the class today. Thank you so much.